Hey, you guys. I'm so excited that you are joining us live today. Hope you had an awesome Thanksgiving last week. Really hate that I missed you guys and was not able to be live, but I was enjoying family and doing the things that I hope all of you are doing as well on Thanksgiving Day. So I'm just going to just jump in a little bit. I'm going to tell you a couple things as we're waiting on people to come online. Just remember that all of my lives are done through StreamYard. And with StreamYard, you have to give them permission for me to actually see your name. So if you are jumping on live, whether you are inside the Calculated Profit Pursuit Facebook page, or if you are joining us live through YouTube, just make sure that you've given StreamYard permission so that I can see your name as you're making comments. Also, I will tell you that there will be a replay of this, so you can go back and watch it later. That's fine too. And when you're on here, if you'll just make comments, ask questions, that's what I'm here for, to help you guys with all of your bookkeeping and your finances for your business. As a reminder, my name is Stephanie Manley, and I am a proactive bookkeeper and virtual CFO. And I'm here empowering family-centered entrepreneurs to really take control of their business finances, have that financial clarity that you so want, so that you're able to scale your business. Super, super, super important. So I'm just going to jump in here. If you're joining me live, you'll say hello in the comments so I can chat with you after. And if you're happen to catch the replay, always hashtag replay for me so I can connect as well. And we're wrapping up the end of the year, right? There's not that many days left of 2021. It feels like it has been such a long year, but so short for me at the same time. And so today I'm coming to you guys, and I'm going to give you 5 year-end tax tips for self-employed entrepreneurs. So these tax tips are for you if you are just self-employed. So you're not an LLC, you're just doing business like a DBA, or if you are an LLC single member. Now, there's some tips in here that will translate over to partnerships and SMC corporations as well. But for the most part, I'm talking about those self-employed individuals. All right, so I'm just going to jump right in here. But before I do, I will tell you that I want you to start thinking about this year. So, we only have so many days left of this year, and I get that. And I hear from other entrepreneurs, and they tell me, well, this year is gone. I'm not going to worry about 2021 anymore. I'm going to just focus on 2022. I'm going to go ahead and start for 2022. But as someone who's been in this industry for over 25 years, I'm going to tell you that now is the time to really put all your eggs in the 2021 basket so that you can finalize the year on the right foot. So yes, you need to start thinking about 2022. I agree, but don't pump your brakes quite yet on 2021. Okay. So again, I'm just going to jump in. The first tip I have for you is you need to time your income and your expenses. Okay. I'm going to look at my notes back and forth as we go. But what do I mean by that? I mean that maybe it's time for you to wait on making some invoices to your clients, right? For you to get paid. And maybe it's time for you to expedite paying some expenses. All right, so what does all this mean? Well, if you are an LLC single member or you are a sole proprietor, meaning you're a DBA, 99% of you are on a cash basis of accounting, okay? And what that means is on your taxes, you report all the income that you reported within that year, or you received, within that year. And then you claim all the expenses that you paid in that year. Okay, so all the money that you've received, you have to claim as income, and all the expenses that you pay, you get to claim as a deduction. That's what that means. So if you're looking at your books, and I'm assuming that they're all caught up to date. If not, we can talk about that at a later date. But if you're looking at your books and you see that you are showing a profit this year and you have a lot of bills, or excuse me, a lot of invoicing that needs to be done for December, maybe you should hold those until the end of December so they'll pay you in January of 2022, because then the income's not going to be counted until January when you receive the money. Okay, so the same thing is true for those expenses that you have. So look at your expenses. Do you have like a year of, say, a Canva maybe, or a year of ConvertKit, or different things that you have in your business that you pay an annual subscription to? Maybe it's time to go ahead and renew that subscription this year. But I would only suggest doing that if you have a profit in your business, right? So it's all about the timing, and you have to know where you stand in order to know which direction you need to go. Okay, so if you're showing a profit, maybe let's hold off on some of those invoicing to clients so you're paid in 2022, and go ahead and pay those expenses. So look at and see what needs to be paid. What can I go ahead and pay that maybe it's not due until like the first week of January, but I can go ahead and pay it in December 2021, and I'm able to deduct that on my taxes. Okay, so just think about those things. All right, the second, and remember as I go, pop those comments. I'm here to help you. Number two, I want you to make the most of depreciation. All right, so let's start with what the heck is depreciation? Well, let's say that you buy a big piece of equipment in your business. Maybe it's an iPad. Those are pretty expensive, right? Or a MacBook, or a new computer in general. Maybe you had to buy a vehicle for your business, or a large piece of machinery. Well, Uncle Sam says you can't deduct the whole price of that item in the first year that you buy it. Okay, it has to be depreciated. And depending on the lifespan of the item, things are depreciated between 3 and 39 years. Okay, depending. Most things are in 5 to 7 to 10 range. So let's say you bought a MacBook and it cost you $2,500 for the MacBook. Well, Uncle Sam says you cannot write off $2,500 as an expense on your taxes, but you can depreciate that item over a 5-year period. Well, luckily, there's some new rules for depreciation, and you're able to deduct the $2,500 if you meet certain rules. Okay, and again, you need to know that your books are in order to determine whether or not maybe it is time to go ahead and purchase that MacBook that you've been needing, or maybe we're going to use the full depreciation. Maybe you're going to use it over a lifespan of 5 years. Okay, but you need to make the most of the depreciation and the limits that are allowed for you on this. Hope that doesn't confuse you too much. So just pop the questions down if you have any questions. And my guys, I'm sorry, I keep looking up and down because my camera is above my computer and I'm trying to make eye contact with you as best as I can. But anyway, so we're just going to keep going. Number three tip. And this one is one that gets overlooked so often. Okay. So what do I mean by fund your retirement accounts? All right. So let's take it back. Maybe you worked a corporate job before you decided to become self-employed, or maybe your spouse works a corporate job. So typically in a corporate job, or you're working for someone else, and they offer a retirement benefit package. What that means typically is they will tell you, okay, I'm just going to say Jane, we have a retirement plan, and if you put in 3% of your pay, then we'll match it with 3%, right? Does that make sense? So the 3%, like, you never even see it. It comes out of your paycheck before you're even paid, so you don't miss it. And then they bump it by 3%. Right? Well, when you're self-employed, that doesn't happen. You don't have someone saying, okay, let's take 3% out of every invoice that's paid in your company and we'll match 3%. Well, you don't have that anymore. right? So I find so often that entrepreneurs wait to start funding their retirement account because they say, well, I'm not really making anything right now. I'll do it later. And later becomes another year, and later becomes another year. And I'm telling you this because that was me. Okay. I've been there. I know. And I wish I had started so much sooner. So much sooner. Because, guys, let's face it, Social Security will likely not be there when we retire. And even if it is, I mean, you can't usually live off of Social Security, right? It's not that high. So I want you guys to start planning now for your retirement. Being self-employed, you have several options, and I'm looking here at my little cheat sheet. So the first thing that you have for self-employed that other people don't have is a plan called a SEP plan. S-E-P, a SEP plan. And a SEP plan is an IRA that you can contribute to. Now, there's a cap on this, and the cap is you can only contribute up to 20% of your profits, not your gross, your profits. Well, if you're not keeping up with your books and you don't know what your profit is, right? You see how this kind of all goes together? Now, the good thing about retirement plans is that you have until next year. You have until April of 2022 to actually fund these accounts. So you have time to gather your information. It does not have to be done by the stroke of midnight on December 31st. So that's a good thing, right? But I do want you to go ahead and set these accounts up. So call the bank, call Edward Jones, call Fidelity, whoever it is that you're going to work with, and set the account up before the end of the year. But you don't have to fund it, meaning put money into it, until 2022. Okay, April 15th, 2022. Excuse me. Okay, you skip a week of lives and your throat gets dry. Anyway, the next thing, the second thing for you to contribute to being self-employed is you contribute to a 401k if you are an employee of the company. So this is going to be one that you would have to be an S Corp or a C Corp to take advantage of. So you're an S Corp or C Corp, you can have a retirement package within your payroll, and you can contribute to that as well, and your company can match it. So I'm not going to get into too much of that, but that is possible. And then you also have IRA contributions. There's two forms of IRAs that I want to talk to you about. The first one is traditional, and most tax people are going to tell you to do traditional, okay? And there's a reason they tell you that. Traditional IRAs have tax benefits today, okay? So if you fund a traditional IRA, you're going to get the tax benefit of that in the year that you have it for, right? So if I did it for 2021, I'm going to see the tax advantages of it in 2021. Okay. Now, I'm not your typical tax person, so I'm going to tell you don't do traditional. My advice is to do the Roth IRA. Okay. And I'm going to hashtag here, not your CPA, not your accountant, not your tax preparer, because every case is different, right? But a Roth traditionally is going to be your better route to go. Now, you're not going to see any tax benefit of that in the year that you fund the Roth, but you will see the tax benefits of that when you take the distributions from the Roth. So when you retire. Okay. And if you look at the history of our tax rates, our rates have increased, right? They haven't decreased. I mean, there may be a little dip here and there, right? But for the most part, if you look at our tax rates now, for those who are retiring now, versus the tax rates for those who were working when they were contributing, then their tax rate's higher now. So history repeats itself, and likely when we retire, the tax rates will be higher than they are now. So where do you want your benefit for taxes? Well, you want your benefit to come where the highest tax rate is. Well, that's probably going to be when we retire. Okay. So I'm going to personally, I decline the tax benefits right now because I want them in the future when I do retire. Okay. Hope that helps you guys. If you have any more questions about that, let me know. But I'm not a financial advisor, but on the tax side, that's kind of where we are. Now, tip number 4 is going to be to make payroll changes. Well, what in the world are we going to do at the end of the year before the stroke of midnight for that? Well, what we're going to do is maybe it's time to pay your bonuses, right? I know I have a lot of clients who they pay year-end bonuses, Christmas bonuses, whatever it may be, profit share bonuses at the end of the year. Well, that's going to help you on your taxes. Okay. Also, I've talked in this group a lot about your kids working for you. And maybe it's time to address that. Do you have kids working in your business that maybe you've been paying with candy or an allowance, but they're not on payroll? Guys, it is so important that if you have children, your own children, working in your business, that they are on payroll. And I don't mean kids that are 16, 17, 18 years old. I mean, I have 10 and 11-year-old boys, and they help me in my business, right? They help me shred. They seal envelopes for me. They do all kinds of stuff. Take out the trash in my office. They dust my office. They vacuum. All these things that a 10 and 11-year-old can do in my business for me to pay them. Now, I can't pay them $20 an hour to shred, right? I can't do that. That would be totally against tax code. But I can pay them minimum wage to do those things. Okay. I have a daughter who is 18, and she helps me with marketing. So I help she helps me with all different things, and I pay her for that. And with that, guys, you can claim almost $13,000 in payroll, right, per child that they pay no income tax on at all. So it's a savings for you, and they don't pay any income tax. So it's amazing. Now they have to work in the business, like I said. They have to be paid a reasonable wage, but that is money that I know you're probably paying your kids anyway. So why not get the tax benefit for those things? Okay. If you have questions about that, send me a DM and let's talk about that, how that can help you in your business, because it has to be set up. It's not something that you can do overnight. Okay. Let's see. And then I will add, just as a little extra here, for those kids, maybe you don't even give them the money. Maybe you put that into a Roth IRA for them, and it's just compounding. Oh my goodness, it's crazy, over the years until they retire. So just think about that. All right. So they have to work, and the rate has to be ordinary and normal. Okay. So just for your area, the age, what they're doing, and you have to keep up with their hours and all that good stuff. Okay. All right. Last tip I have for you is that 2021 is not the year to DIY. Okay. There are so many tax law changes. And I said this last year, but there are even more this year. It's crazy, going through all of my continuing education and the different things, learning all the things. And 2021 is not the year to DIY your taxes. Personally, I don't think it's quite the year to DIY your books either, unless you are a smaller company and you don't have a lot of income and expenses that are coming in and out of your business. Okay. But I will tell you there is a few things to keep in mind when I say do not DIY. DIY means you go in TurboTax or something like that, and you punch in their numbers, and they ask you yes, no, yes, no, yes, no, and you're done. Okay. Well, TurboTax is not designed to look at a bigger picture. It's not designed to give you tax strategy. Okay. You need a tax strategist to help you with that. Some of the things that I see missing a lot are the mileage deduction for your business. Okay, that is something that you need to keep up with, something that you can look into, something why you should not be using TurboTax if you have a business. The other thing that I will address, and this is a big one, is so many of us work from home now, right? We have home-based businesses. I know I do. I don't have a brick and mortar anymore. I work from home. And so we have the home office deduction that we can claim. And how the home office deduction works is the room has to be exclusively used for business, okay? And on a regular basis. You can't just go in the room, once a month, right? It has to be the regular place that you go to conduct your business. All right. And it has to be exclusively used. Well, exclusively means it can't be a corner in your bedroom or an area of your living room. It has to be 4 walls that are only for your business. And it could be an area that you store your merchandise. It could be an area like right now I'm in my studio in my home. Well, this is part of it. I also have a home office that I use as well. So I have 2 places that I use within my home that are for my business use. Okay, so exclusively and regularly. And what you'll need to do is you'll need to take the square footage of the room that you use exclusively and regularly for business, and then you'll need to know the square footage, your heated square footage of your home. And the way it works is we would take a percentage of your utility bills, a percentage of your mortgage or your rent, based on the percentage of that home to your, the room to your home. And if you really haven't kept up with that throughout the year, I hear that a lot too. Well, Stephanie, I really haven't kept up with it, so just don't worry about it. Well, the good news is that on your tax return, you can claim the simplified method, which means all I need to know is what the square footage of the room is and what the square footage of your home is. And those are really, really easy to get. And then we just use the simplified method that's set up in the tax code. So with that, I don't even need your utilities. I don't need any of that. Although you should keep up with it because normally your expenses are higher than the simplified method. Okay, so it may do you some good to actually do some backtracking. All right. Any questions, drop them in the comments and I will actually just message you right back on your comment, and that way it doesn't kind of get lost in the funnel. Several of you have also reached out over the last couple of days because I have a new product out. I haven't really said a whole lot about it, I guess. I did a demo a few weeks ago. But the new product is the Calculated Tax Planner. So if you do not have a system in place right now for you to keep up with your income and your expenses, this is an awesome, awesome tool. Okay. It's not a monthly subscription. It's a one-time. You can go ahead and purchase and download it and use it for 2021 if you haven't done 2021 yet. And then you just make another copy and start fresh for 2022. And it doesn't cost you anything else, right? So you can continue to use this until your business gets to the point that you need QuickBooks Online or you need a bookkeeper to outsource your bookkeeping to. Super, super, super recommend this for you. I'll put the link here is at the bottom of the page. So it's calculateprofits.com/calculated-tax-planner. You can go here. It tells you all about the planner on my website, and you can just click to purchase, and it is a simple, simple download. Again, $47. So less than 1 month of QuickBooks, and you have a year to 3 years worth of software. This software will also track your profit, your losses, your cash margins. It will track how much estimated tax you should be paying and break it down for you by the quarter so you know exactly how much you should be paying. And then everything is ready come tax time. Like you just shoot the yearly totals tab to your tax strategist, whomever that may be, and it's there. It's all lined up. It's ready for them to go. Okay, so I hope you guys have an awesome rest of your Thursday. Have an awesome, awesome weekend. Today is my Friday because I don't work on Friday. So today is my Friday, and I'm ready for the weekend. My husband's off for the weekend, and I'm just excited to spend some more time with my family. So again, reach out if you ever have any questions about your bookkeeping or your taxes because I am here to help. Hope you guys have an amazing rest of your day. Bye, guys.